Good morning. You're watching the market right here on ET Now, and we're coming after a day's break, and lots has actually transpired in that one day. Yes, the nation is now into its 77th year of Independence Day, but just take a look at the markets, because looking at the GIFT Nifty, the adjusted rate actually is indicating at a Nifty futures print that of 19,478, which implies a downtick of about 90 points. Of course, right now we're down about almost 80 odd points already. Also, while we were away, there were some surprise central bank actions coming in from Russia, which has hiked its rates by 350 basis points. And China, on the other hand, has actually cut its rates by about 15 basis points. Quite a few global concerns as well emerging. Fitch is actually warning of US bank downgrade, which is why you're seeing that sharp plunge overnight coming in on most of the US equity markets, the Dow knocking off almost 1% in the red. Fed members are advocating capital regulation on regional banks now. China developer Country Garden is on the brink of a default. So the news flow, Nikunj, from where we left it off on Monday has worsened.
See, Aisha, you're getting a divided view of the world. Yeah. China's cutting rates. Why do you cut rates? Because you expect the economy has slowed down enough and you need to stimulate it by monetary action. Russia is increasing rates because they feel that the economy is doing okay and you need to take care of inflation and other demand factors to ensure that in the near term inflation does not run away. So you are looking at a divided world, and I think post-COVID that really seems to be the factor at play. There is no universal fact where, okay, US Fed has increased rates, everybody else will increase rates. US Fed has cut rates, everybody else will cut rates. No, that is not happening. But for me, I think the global headline, is that the China slowdown, China comeback, which everyone again thought, I don't know why, which everyone again thought is going to be the story of the second half of 2023 that is getting challenged. What had led to that Chinese recent data, that markets started thinking that China will open up, demand will come back, flows had started gravitating back into China, and commodity and metal prices, they had started rallying. If China has cut rates, and this is not a bull market, this is a time when they are cutting rates, when inflation is high, this means that the demand is not going to be that strong. Demand does not remain that strong, which means I see the following happening. I think commodities will peak out, especially base metal, industrial metal, steel and both ferrous and non-ferrous. B, I think the money which moved into China, I don't know why, but the money which moved into China, again, everybody would be asking that why do you want to go to China when the unlock trade has failed and when the comeback economy trade is not real. So for me, the messaging is that if the Chinese economy is getting supported by monetary action and looking at the demand scenario, it is highly unlikely that this indirectly will really benefit a market like India.
Okay, so clearly you did have a lot of those financial stocks coming under acute pressure on Wall Street, and it was a losing session with all the major indices wrapping up in the red. You've got the Asian screen as well, along with banking stocks retreating this morning. But what about the cues on Monday? Well, we wrapped up the trading session at around 19,434 levels for the index. We did see that bounce back from the lows, and that was towards the fag end of the trading day. You had the broader markets, though, that underperformed, and that was pretty evident with a wrap of about a 0.7% cut on the small cap end of the market. In fact, it was the global cues that clearly seemed to weigh down on the metal sector. We've come off from those recent highs on the Nifty Bank by close to 2,100 points and on the frontline index by nearly 550 points. And banks, Nikunj, continue to remain the weak link.
So let's look at the recent data. The bank Nifty from the recent has down by 5%. And during that same time, the Nifty has taken a knock of about 3%. Now, the bank Nifty or the banking index has been the market of choice. This is where all the overweight positioning is. This is where the market action has been the strongest. This is where the price action also has been the strongest. But of late, things are reversing. So if the leadership sector reverses, you could ask yourself why? And what should one read into that? So the decline in bank Nifty, I won't say it's alarming, but it is a telltale sign of the market mood when a performing sector like the banks or financials, they start retreating. And this time around, the decline actually has been led by the most haloed and the favorite group, which is private banks, whether it's a combination of HDFC Bank or ICICI Bank or perhaps both. Meanwhile, the market also are looking slightly puffy-duffy. Nifty future premium has declined. Fresh short positions are getting added. There's nothing alarming in the market, but I see the following happening. I don't think markets are going to go up in a hurry. The bias of the market clearly is on the downside. the mid and the small cap stocks selectively, I think, are showing signs of fatigue. So it is fatigue in the financials. It's a reversal in some of the patronized trader stocks, and I think I don't you want to use the word sharp sell-off, but a sell-off in the small and the mid-cap stocks cannot be ruled out. We are not there yet. But if the direction of the market has changed, surely the internal workings of the market will also change. The headline is that the Bank Nifty, the leader index, is down.
Yeah.
That is not great news. And if the leader index is down, it clearly means that it will have its inertia, and the inertia, I think, will only get more and more pronounced on the downside. So the strategy is that I don't think you should still go short. It's not a breakdown, but you just want to avoid buying, avoid your commitment levels, keep your gunpowder dry, because if the global data continues the way it is, then surely this market will give you a great buying opportunity sooner than later.
Yeah, and just on the point that we were making about the divergence from the central banks, both from Russia as well as China, for us as well, we are sort of at a crossroads, and inflation clearly is resurfacing. The data seems to be suggesting the same. The fact that CPI is now at a 15-month high of 7.4%, and this is in a stark contradiction to what you saw in the month of June, which was at 4.8%, when everyone thought that inflation is a forlorn story. In fact, the July CPI print is a good 257 basis points higher than the month of June. Food inflation, as we all know, has already risen up by a staggering 11.5% in the month of July. Vegetable prices alone have seen a whopping 37.5% nearly jump up coming in the month of July. And retail inflation, that was below, of course, the 4% which it clocked in September 2019. That's on a year-on-year comparison basis. But yeah, the bigger question mark is how longer can the central bank, for us, that is RBI, will remain in pause mode? Because if inflation does not get controlled here, then we're in for a rate hike.
See, there's the if there, and I think the if is where the variable factor is. Sometimes that like 2021 after the war, 2022 after the war, you knew that inflation would haunt you for a couple of quarters. This food inflation, tomato and other vegetable prices. Now I can argue back and say that this should cool down because we had delayed monsoon, and this time around the vegetable crop sowing is decent. So you will not ring the alarm bells, but you want to be a bit watchful. What this will do is that this surely will take all the assumptions of a rate reversal away. So you can't make a case for a rate increase, but a rate reversal is surely out of the window. Let's hope that China data, which is not looking all that encouraging, and we have crude and other prices have reversed, that it will just only have an impact on the way our commodity prices move. So at least one concern has been taken care of. I think this is more like a seasonality which is at play, and which is what Reserve Bank of India is driving comfort from, because 7% inflation, and if it appears that it could last for another 3-4 quarters also.
48 months on the chart that it's been above the RBI's comfort zone in terms of the print.
So it's mathematical, Avan. Mathematical is that it's a combination of basket, and that combination of the basket, when it moves, it will be captured. All markets are saying, and all of us are hoping that this is seasonal. This is seasonal, because if this is not seasonal, and if this persists for another one more quarter, then trust me, Reserve Bank of India, they will not have to use the guns. They will have to use a machine gun in this case to bring inflation down, because we are reaching that level where it's not going to be tolerated. I think the Prime Minister also made a remark that,
where he said we've imported a lot of things globally, and one of the things that we've imported is high inflation, and this is a challenge, he said.
And you're reaching elections, state elections followed by central elections. So inflation has to come down.
And food inflation, which is so consumer sensitive.
So it has to, if it does not come down, then we are in for a big sharpish move from Reserve Bank of India. But I doubt that Reserve Bank of India increasing rates, will it bring vegetable prices down? What can you do about it? There's nothing can be done. It's a factor of how the patterns have moved in terms of the vegetable sowing.
Okay, so perhaps have to bring out the heavyweight machinery if inflation isn't curbed in the upcoming, by the time we have the upcoming policy meet. All right, let's move right on. The stock in focus today is clearly going to be ITC. Two triggers. One, the fact that it came out with its numbers. It was a mixed bag. You had profits which came in above street expectations. And then, of course, the devil in the details when it came to the fine print of the demerger. They've approved that hotel biz demerger, and the entitlement ratio at 10:1, Nikunj, with a listing likely in the next 15 months.
First, the numbers. I think if you look at cigarette volumes, 7-8%, okay. They're gaining market share from the illicit market. FMCG business, I think they're impressive. When rest of the other companies who have a turnover of 20,000 crore, they've struggled, ITC has reported a margin expansion. See, frankly, if I look at the total top line, the top line was difficult to assume. Why? Because there were ban on agri exports, and it's a judgment call that how much ban would have impacted for the quarter gone by. But that's the reason why the top line, in a sense, may not look all that great. And then there is a hotel demerger ratio. My understanding of the hotel demerger ratio is that it's been done very thoughtfully, and it's been done thoughtfully because in this entire merger, new shares would be issued. If the new shares are being issued, that you have to ensure that because after the issue of the new share, the total underlying value of the ITC hotel does not fall and does not become a penny stock. So there's a technical thought behind it, but it's a thoughtful thing. ITC, I think, has been in performing stock. So it is unlikely to see massive upgrades, but it is a stock where I think the terminal value versus the current market price, the upside is still visible in the medium term. I will not be surprised that post these numbers, the stock starts outperforming the FMCG basket. Look, it's not going to be a multi-bagger like it has been. But if you have to really look at the construct of the FMCG sector, large companies, I'm not talking about small companies here. You got HUL where you know the numbers and margins and market share concerns. The best of the margin expansion is behind us. You come to Nestle. Nestle for the quarter gone by, volume growth was a concern. Then you come to Marico, not big in terms of size. ITC FMCG business, I think, is growing and the margins are expanding. So within that cohort or within that ghetto of FMCG, I think ITC will outperform, and it has outperformed, continue to outperform. Now I don't think it has got enough and more valuation to appeal that it will continue to outperform the Nifty now. It has been a Nifty outperformer. I think now it will be an FMCG sector outperformer.
And to the point that you were making on the demerger math as to how is it that they derive this 10:1 equation?
See, when the demerger happened, they'll have to issue fresh shares. If they would have issued fresh shares, the demerger would have been 1:1, then that would have led to a lot of dilution, which would have led to the price of ITC hotel come down to 9 to 10 rupees. My sense is it's been done because you want the underlying market, the price discovery, which should happen at a higher price. 5% is what you think is the FMCG value, is the hotel value. If this entire structure goes through and if the hotel sector is doing okay, I think the price discovery for the hotel stock, whenever it will list, I think it will be above 50 rupees, which I think would mean positive surprise in due course of time.
Okay, and you also had CLSA, who has come out with their latest note on ITC. They've got an outperform rating with a 480 rupee target price, saying that the demerger is only going to sharpen the company's capital allocation. Certainly a stock to watch and trade today, but along with that, there's also going to be Z Entertainment that will be in the spotlight. As SEBI has issued the confirmatory order, they are going to complete the probe within the next 8 months, and they've barred Subhash Chandra and Puneet Goenka from holding any directorial or key managerial positions in Z Entertainment and the group companies. Karan Taurani joins in from Elara Securities to give us his view on the same. And Karan, just going as per your last note, you had said that there isn't going to be too much of an adverse impact on the merger with respect to the SEBI order because Puneet Goenka has already stepped down from the board. But just wanted to get in your thoughts on the fresh set of news.
Hi, morning. So if you look at this, I think the last time when SEBI side came up with the statement, I think they had given a timelines of almost about 5 weeks to complete the process. Now, something would have come out in the probe or some time would have been needed, for the investigation to be completed, which is why the timelines now are extended towards 8 months. Now, if you look at the current scenario, Mr. Puneet Goenka is not on the board. He's also stepped down from day-to-day activities. And I don't foresee, Sony is going to wait for 8 months, for this probe to end. So I think for now, the merger will probably go through without him. And once we see an outcome in terms of, what is going to happen from his end, he might join back the company or they might have some terms, with the Sony management. But for now, I think it's very clear that over the next 2 months, you'll see the merged entity being formed. And that's going to be without Mr. Puneet Goenka.
So for a minority shareholder, what does this mean? I mean, this technically means that the merger will not go through, or in this case, the Goenka family will have to step down, perhaps resign, or they may not be involved in day-to-day matter because everybody wants the merger to go through.
Yeah, so as I said, there is no overhang because of this, for the merger, because Mr. Goenka has also come out in media and mentioned quite clearly that if at all, he needs to step down, if he needs to resign for the merger to go through, he will make sure that, that merger is not stalled, primarily because of his investigation. Both are different separate matters. The mergers between two entities and the matters related to the Goenka family only, not related to the merger. And now that they've got a very clean sheet NCLT approval without any kind of conditions around creditors or any condition around this SEBI SAT issue, I think the merger will eventually go through without him. And over a period of time, I think, he's already moved out of the board. He's already moved out of the day-to-day activities. He might be even asked to resign, and post that, Sony will take over control. So I think in terms of shareholders, it's more of a neutral impact, because it's just that Puneet Goenka was supposed to be a CEO. They'll have to probably find a new CEO. There might be some transition time, 3 months, 6 months, because someone else who's going to come and take over Z will require some sort of time. But beyond that, I think there's nothing negative as such.
And for the merged entity, Karan, what kind of execution is it that you're expecting? What is it that, is the rationale behind that core business, broadcasting business valuation at about 20 times 1 year forward PE, according to you?
So I think if you look at this company, firstly, they'll become too large in the ecosystem. They'll have close to 25% ad market share. They'll have about, 25% viewership share as well, and plus a larger share on the subscription side as well. So I think they'll become quite large. They'll become number 2 as a player. That's one. Second thing is, a lot of corporate governance issues will kind of get resolved. You'll see better cash flows, for the entity. It will be MNC backed, right? So you'll have a lot of synergies as well from the MNC counterpart in terms of the technology, in terms of the expertise around OTT, which is like the very big thing. And I think, these things put together will lead to a better re-rating multiple, for the company. Last but not the least, I think the ecosystem is changing. Disney has clearly mentioned that they're looking for a partner, or they're looking to exit the linear TV business in India and globally. So if that were to be the case, I think, moving on to the number 1 position, if you look at Z Sony, the merged co, they're at number 2. But if at all there is some change in, Disney in a very big way, you could also see, Z Sony moving on to number 1. So I think there are ample triggers to play. And that is why we valued, the PE at 20 times for the broadcasting business.
Right. Okay, Karan, always great to have you on board and give your opinion on the markets, in fact, or rather on Z and Sony, and how the latest news is going to impact the shareholders as well as the proceedings in the case. Shut shop at 19,478, although this morning the GIFT Nifty is indicating some more downside. The adjusted price for yesterday, about a 90-point downside, is what we're staring at on opening bell. So let's bring on board Kunal as well as Naresh and find out what they're making of the trading structure right now. Kunal, Naresh, hi, morning. Kunal, let's start off with you. Where do we find the next support, considering the GIFT Nifty is already indicating some more downside?
Good morning, Aisha. So, I think 19,300 still remains to be a key support for the index, even though we've had 3 breaches or breaks of the level on intraday basis. But then when you look at this on the closing basis, we've managed to protect that 19,300 mark, quite strongly over the last 3 attempts as such. And when we look at the trend line supports, specifically the hourly charts trend line for the index, even the support of the rising trend line manages to coincide at that closer to the 90,300 mark for the index. So we would actually decisively wait out for a breakdown below that 90,300 mark. And if we close below that 90,300 mark, even with a margin of 50 points, 70 points on the downside, say, which means closer to 90,230, 250 on closing basis, that could be a strong confirmation of a change of trend for the index. Till then, I would probably believe that 90,300 is a strong support, and we may just hold on to that level for some more time before we see any kind of a major reversal in terms of cues. Now, the concern for the markets is global factors which have been starting to deteriorate, whether it's the correction in the US markets, rise in Brent crude, gold, etc. So I think that's one of the major concerns which have risen up in the markets. That should narrow down the expectations for the index, but in terms of technicals, we'll wait out for a breakdown below the 90,300 mark on closing basis.
All right, morning, Naresh. Let's get in your thoughts. More pertinent to talk about the Nifty Bank, which is off nearly 5% from its recent highs. What is that indicative of for the overall market mood?
So, similar to the Nifty Bank is also stuck in the same band. The only difference is it has broken the recent lows, which was similar to 19,300 for the Nifty. Similar low for Bank Nifty was closer to 44,300. We broke below that. We are retesting the band which was there in June. So if we go back to June, Bank Nifty was stuck in a tight band of 43,300, 400 to 44,400. That was the 1,000-pointer band. So out here, a significant trend change level comes below 43,500. So for now, the drift has been a little more on the Bank Nifty, but 43,500 remains a critical level because that is roughly the range high it was made in 2022 end as well. So 43,500 becomes a very crucial level. On the upside, till the time we don't cross above 45,000, the momentum does not kick back in. So a zone for 43,500 to 45,000 for the Bank Nifty. For the Nifty, it is now 19,250 to 19,550 going forward. That should be the range. Once that breaks, we get say a 300-pointer move on the Nifty and maybe a 1,500-pointer move on the Bank Nifty. So for now, we are stuck in this range and could stay here for some time.
Right, let's talk stocks then. Kunal, what's on your list?
So I'll go with Reliance Industries as the first stock showing signs of outperformance even at current levels. Targets of 2640 for Reliance and stop loss at 2540. Expecting that streak of outperformance to continue for at least another couple of days for the stock. Titan is a stock which has bounced from I think 2,900 levels to 3,000 plus levels. That's a stock which has actually come back towards a good shorting territory. It's also coinciding, the stock is coinciding with the short-term moving average in terms of resistance. So would suggest a sell on Titan, targets of 2,900, stop loss at 3,060.
All right, let's get stock specific. Naresh, what is it that's looking good on the charts today?
So looking at stocks which are more on the mid-cap side. So first is a buy on NMDC. The stock has given a breakout and saw good volumes on Monday. Out here 120 is the recent high. If that crosses, it should get more momentum. Looking at it as a breakout trade going forward. Stop loss at 114 and a target price of 135. Second is a buy on Care Ratings, which is on verge of a 3-year breakout around that 760, 780 mark, which was the high multiple times over the last 3 years. And the whole trend is shaping up really well for the ratings basket. We've seen CRISIL, ICRA as well as Care, all of them hitting new 52-week highs. Care looks the most interesting one given the fact that it has corrected quite a lot over the last 3-4 years. So looks like a longer term trend change here. An initial target price of 850, a longer term target price would be 1,000, 1,200. So out here buy with a stop loss at 740.
Right, okay, let's talk stocks which are going to be in focus this morning, and we've got Infosys as well as Zomato on our radar. Anisha is here to highlight all the stocks to watch out for this Wednesday morning. And Anisha, Infosys, a 5-year mega deal with Europe-based communications and telecom group Liberty Global. What does it mean? What is the deal all about?
Oh, well, yes, at least last couple of weeks we have started hearing more about deal wins. It was HCL Tech that had bagged that mega deal over $2 billion, and now it's Infosys as well. So the deal size, as you pointed out, is around $1.6 billion, 1.5 billion euros. It's a 5-year deal that they've tied up with LG for building up their digital portfolio. The deal is extendable beyond 8 years as well, and that means that the total deal value, if that upside is available, could be around 2.5 billion euros as well. Now, the deal should start at the end of this year, so in FY24, don't expect a material contribution. It can be limited to almost 30 to 50 basis point worth of revenue in FY24. In fact, to begin with, such large deals are usually margin dilutive because the companies have to incrementally invest a lot more in the headcount initially, while the billings and the upside and the scale up happens later. So the deal at start in the near term might be margin dilutive. At least that is what JP Morgan is also saying. But what the deal does is give good amount of visibility for FY25 as well, because of course there's no double-digit growth at all in FY24. But now, Nikunj, the questions are being raised that at least will we see a double-digit growth in FY25? Deal wins is something that has been happening, but doesn't look like we're out of the woods yet for the IT stocks.
Nisha, look, the base for FY24 will be low. So obviously FY25, the base will automatically ensure that for the sector per se, I will not be surprised if you get a double-digit growth. Now, nobody is saying that IT sector is going to not grow. IT sector will grow at a rate which is much lower than what the COVID sugar rush was. And that is what I think is taking market some time to adjust. So this deal for Infosys, I think, is a welcome move. That just tells you that Indian IT sector, even though we're talking about the disruptive move of AI, the bread and butter business is still there. But the rate of the bread and butter business, the growth of the bread and butter business, I think is challenging. My only view here is that IT stocks today, you want to buy something which is cheap if you're going contra. And IT stocks, most of the IT stocks, the large ones, they're not trading way below their 5-year average. In fact, some of them are trading above their 5-year average. And in the near term for next 2 quarters, I don't think there is going to be any big change in terms of the management commentary. So either you wait for these stocks to become cheap, or you wait for a significant change in terms of the global macro environment. And I don't think both those factors are at play. So the stock may see a deep swell. I mean, some of these stocks have fallen down so much, these institutional driven stocks, so it may see a deep swell. But it just does not address the 2 concerns which I've been raising. One, what happens to the macro challenges, which in a sense have hit the business, US banking sector, insurance sector, European slowdown. And B, I really don't know at what point in time what really would be the arbitrage of AI versus the traditional business. So sector will grow, Anisha. I mean, nobody's saying the sector will not grow. And large deals were announced by Infosys even in the quarter gone by, yet they gave a profit warning. So I will welcome the deal, but I will not think that this sector is looking so cheap that you really want to go contra. Just because pharma is up, everybody's saying IT will come back. Don't do that mistake. That's my limited point.
Okay, that's one stock to look out for. Anisha, what about Zomato? What does Morgan Stanley now have to say?
Well, actually, the annual report is out. They've passed through the annual report, and they think that its growth concerns are being answered in the annual report as well. So some of the points which have come out suggest that they have been growing faster than the competition, at least in the last couple of years as well, and that trajectory is continuing of gaining market share. In fact, if you look at the gross order value, there also the company has managed to increase the market share, and now they are expecting that the food delivery segment will get to 3.5% adjusted EBITDA margins by FY25 itself. In fact, the quick commerce business, which was a big question mark, people were raising question marks about the Blinkit acquisition and the capital allocation. Well, they believe that quick commerce is showing signs of a sustainable business model. So yes, there might be a bit of burnout as far as the cash is involved, but nonetheless, there is a path to profitability, and that is what they like. In fact, they are saying that the positive free cash flow, which will be there in the food business, will be able to offset the losses in the other verticals. So they have come back positive from the read-through, which Zomato is saying in the annual report. But the big question, Nikunj, is where do we go from here on? I mean, the stock is no longer very cheap, right? At 45.50, in hindsight, we can say it was a clear buy. But at 90, you would question yourself again, right?
You're nearing a market cap of 75 to 80,000 crore at about 100 rupees. And 80,000 crore is a big market cap for any company, even though it's maybe a high growth company. Now, what has changed for Zomato? I mean, the whole proposition that they will never make profit versus how much profit they will make. And B, their grocery business, which is the Blinkit business, that is looking like a business that looks like it has a sustainable business model where in future they can make profits. For me, I think, Anisha, the things which will matter now in the short term are they going to be gaining more market share from Swiggy? Look, I mean, ultimately it's a fight between 2 players. And we can look at Swiggy for the better part has always maintained that they've got a higher market share. But given the turf right now, are they gaining market share from Swiggy? And that I think would be a driving matrix for them. And B, what and how soon the Blinkit acquisition in a sense is going to be turning around. Also somewhere in FY24, I will not be surprised that some of the investee companies, if they start going public, Shiprocket, Curefit, so that could be the real trigger. But you're right, at 90 rupees, that surprise, that excitement, that case of a turnaround, that magical move in Zomato, all that I think is behind us now. Now there would be a different way in which markets would be judging them. A year ago we were saying, oh, will they ever make, how much more losses they will make. Now we are saying that, okay, how much more profit they will make. That's a change in narrative.
Yeah, absolutely. Doubled from those 40 odd lows. Anisha, thanks for highlighting those 2 stocks and why they should be on your radar this morning. On that note, we're going to take a very quick break. Come right back. We'll have our fundamental experts as well joining on the show.
Welcome back. Let's connect with Amitava Mukherjee, the Chairman Managing Director at NMDC, to talk about the quarterly performance. Will there be a continued increase in prices? Let's find out. Thanks so much for taking the time out. Mr. Mukherjee, to begin with, although your revenue has declined sequentially, you have maintained your margins at 37%. So can you tell us what the outlook is for the rest of the year?
Q1 to Q1, actually, our revenue has increased by around 11%. So that's a good sign. And this has been mostly not due to the prices, but due to the volume. As you see that our volumes have grown substantially to around 11 million ton in the Q1, which is the highest ever Q1 since inception, both in terms of production and in terms of sales. Margins, of course, the pricing pressure has always been there because this Q1, the prices have been at least around 30% lower than the Q1 of the previous year. But because of the volumes, we've been able to maintain our margins, and our EBITDA margins has also been close to around 40%. So that's a sign, that's a matter of satisfaction that despite the pricing pressures, we've been able to sustain both the volumes and the top line as well as the bottom line. So that's been the satisfactory part of our Q1 performance.
Sure. What's the outlook then on coal and coke prices, and consequently, will margins improve further from the current 37% mark?
Yeah, I hope so, because as the volumes go up, you see, this is a fixed cost industry. As the volumes go up, our cost of production keeps coming down. So to that extent, yes, our EBITDA margins is likely to improve as we are able to increase our volumes. And as you know, that we are looking at anything between 47 to 49 million tons in this financial year. And hopefully we might even touch 50 million ton if things go right. So with the increase in volume, obviously the cost of production per ton comes down very, very substantially, which of course will give a positive effect on our EBITDA.
And how confident are you of achieving your guidance of 50 million tons of iron ore production for FY24? What will be your medium-term iron ore production target, say, over the next 2 to 3 years?
Yeah, 50 though, obviously 50 million ton though we will touch hopefully this year itself. We don't have to wait for next 49 or 50. We should be able to touch this year. You see, there are 2-3 factors that are why we are confident. Is one, the Kumaraswamy approvals have almost come, except for one. I think we've got the EC, so the production capacity goes up from 7 to 10 in Kumaraswamy in Karnataka. We have a 2 million ton capacity project going on in Bacheli, which will be commissioned by 1st of October this year itself. And there are we are also working 365 days a year, so that will go give us some 2-3 million tons, as well as few of the mines which were working 2 shifts. We'll work them with 3 shifts. We are putting in additional manpower and additional equipment to enable that. So taking all these factors, I think 50-51 in the coming 50 this year and around 52-53 next year should not be a problem. However, going forward, we are looking at around by 2030 about 100 million ton. We are investing in that, so the investment has just started. We are making 2 screening plants. They would cost us around 4,000 crores. One is already halfway through. The other at Karnataka, we have just tendered out. So there are a lot of capacity augmentation plans that are underway, and some would be coming in stream in the next 3-4 years. So around 100 million ton, along with our subsidiary, which is the NMDC CMDC Limited, both together we should be able to do 100 million ton.
Right. About your Nagamar plant right now, we believe it's commissioned. Could you throw some light on the total cost incurred? When will the core scale up production?
First is, of course, the blast furnace has been commissioned. We have lighted up the blast furnace on 12th. We expect the hot metal to come out in a day or 2. And then we'll be taking it to the SMS and rolling the plates, rolling the coils. So I think in another 3 or 4 days' time, the entire integrated operation will start and we'll start commercial production. This is one of the most modern plants, and whatever products we make would be premium products, which will carry a premium of around not less than 5,000 in the market. So in the first year, we are planning around, that is the H2 of this current financial year, we hope to reach around 1 million ton. We have a problem that we don't have a lime dolo plant that has not yet come up as yet. So we are depending on purchased lime and dolo. Despite that, hopefully by next year, we should be able to do going forward at least 2 million ton and break even in around 9 to 10 months time. I think that is that is what we hope.
And is NMDC looking to acquire stake in NMDC Steel at all?
There are talks that around 10% stake would be offered to NMDC, although formally such communication has not been received as yet. But as and when it does, of course, we'll look at it. Obviously, we do not mind taking a 10% stake on that. So let us see what the offer is. As of now, the firm offer or any concrete offer is not there. But yes, we've been sounded out, and we'll take a call when the formal offer is made.
Right, and any timeline that you could share with us with regards to government's disinvestment plan? When will the bids be invited? JSW Steel, we understand, was looking to participate in the bids. Could you throw some light on all of that?
You see, this disinvestment process is being run by Deepam and not us. But we are a part of the process. So what I understand is that against the UI, several offers have been received, and a lot of people have shown keen interest in buying the plant, which is very obvious because this is a very state-of-the-art plant. There's no doubts about that. But the timelines would exactly, I will not be able to speculate on that. But I do can assure you that once that this commissioning is done in the next 3 or 4 days, the pace of the process would be substantially picking up. That is what my understanding of the situation is.
Appreciate your time. Thank you for joining in and giving us a view on how things are shaping up at NMDC. Let's connect with Chakri Lokpriya as well, who's joining in on the show. Chakri, hi there, good morning. Lots to start off and discuss, but let's begin with your views on ITC, the demerger fine print, and how you've looked at the numbers.
Good morning. I think, as I always say, that the devil is in the details. So in this case, the tax implications of the demerger will play a key role in determining the subsequent valuation of the business. And, this is a business which, the hotel business, which is a cash flow intensive, capex intensive business. And, them moving to an asset-light model is a more a future tense kind of a thing. But how do they service that? So I would still wait before, taking the leap into it, given that it's already done so phenomenally well.
From 449, where does ITC head from here?
Well, I think ITC has a tendency of going into multi-years of sideways range. So after such a kind of a steep rally from 160, 180 levels towards 500, I think at one point the stock was very close towards breaking that 500 mark. I would expect a major consolidation for ITC. We saw that very similar kind of a pause for ITC, I think in 2017-18, when the stock topped out at 300 odd mark, and from there the stock went into a 2 years of sideways range in 2018-19, and then the second half of 2020 the stock corrected. So I think I would probably expect the stock to go into a pause. It's the best time for option writers who have been sitting out or sitting on the fence to start looking out for more strangle kind of strategies for ITC. I think that's a better strategy at this point of time, rather than taking a trending call or a positional call and expecting the stock to outperform or give same kind of a performance of 2x, 3x in the next 1 year. I think that's a bit of a far stretch for ITC.
All right, there you have it. That's the view coming in on ITC. But let's shift gears then and find out the stocks that are on the editor's radar today. Well, we've got Interglobe Aviation or
Indigo.
Indigo, I don't know.
Indigo.
Or Indigo, that's in the spotlight. Okay, now the Gangwal Group has started selling stake in September of 2022, and yet again, Nikunj, there has been a 4% stake sale. Walk us through the outlook and what's working. Why?
Indigo. happens.
Yes, it happens. And you know what the implications are, just looking at the aviation industry as a whole.
Look, this is not the first and this will not be the last of the promoter stake sale. But what it does is that the overhang of, let's say, 25% stake sale versus the current post today's deal, the residual which would be left, I think that is getting reduced. The fact that Indigo has been in performing stock, I guess it just makes you wonder that where the stock is headed right now. So my view on the aviation sector, I think, is that whatever blip we saw in terms of air traffic number, that's not going to be substantial. B, my sense is that Indigo and Tata are the two large forces to reckon with when it comes to the entire aviation sector. See, I genuinely feel that there would be a price discipline in the aviation sector. I mean, unlike the Geo moment, I don't think Tata's entry into Tata's takeover acquisition is going to be a disruptive move, right? So I think once the block deal goes through, this is not the first, but this will not be last. But the overhang, I think, progressively is getting reduced. The stock has been an outperformer. The news from the China, I think, is a clear indication that commodity prices will not go up in a hurry. I will not be surprised that the outperformance in the stock actually continues.
Okay, but at the same time, you also got analysts, Nikunj, who are expecting losses perhaps in the coming quarter.
Yeah,
we
so
did talk about the short-term moves.
So the coming quarter may not be all that great because the company has come out in the open and said that, look, we do expect a drop in realization and we do expect that there would be a drop in terms of where the traffic is moving. But you have to just go beyond. You have to look at Indigo and ask yourself that, look, this company, I think, has got all the ingredients of managing a tough time. It managed COVID very well. It managed the 2021 time when the crude prices went to $130. They are, airline is a tough business. Look at the history of aviation sector, both locally and globally. The companies which have filed for bankruptcy, I think, is huge versus the companies which have really survived. And Indigo is one company which has survived the storm. There's a technical overhang of stake sale, but my point here is that with each passing quarter, that overhang, I think, is getting reduced.
Yeah, it stood the test of time, at least so far. Overhang reducing. Let's find out, Aisha, what our market experts make of this stock as well.
Oh yeah, absolutely. And one would think that you would remember Indigo and not Interglobe Aviation, but it's the other way with Avan. Chakri, you just heard the commentary on Interglobe. Just wanted to understand where is it that you stand in terms of an investment view on the stock?
From an investment view, it has all the ingredients like, fantastic market share, the execution is good, not too much price competition, but it's still subject to the global vagaries of oil and lease prices. So those two variables it does not control. And pricing has always been a big issue in India, airline pricing, that is, ticket pricing, and which they don't have actually that much control over, subject to regulation. So given all this, I think, these are good positional investments, but not long-term buy and forget kind of stocks.
Vishal Gada joins us, Managing Director and CEO with Artis Consulting, to walk us through that whole ITC hotel demerger and why they've decided to give not 1:1 stock, but it is actually 1:10. So Vishal, let's understand the thought behind it. Why are they doing it? A simple demerger would have been the existing shareholders get one stock of ITC hotel free. That would have been simple. This sounds slightly more complicated. Why is that?
Glad to be with the ET Now viewers. Actually, it doesn't matter what is the share entitlement ratio, and let me explain you why. See, this is a demerger where all the shareholders of ITC will have direct and indirect 100% economic ownership in the new ITC hotels business. So what the company is doing is that they are demerging the ITC hotels into a separate wholly owned subsidiary. And post the demerger, the ITC company will hold around 40% and the ITC shareholders will hold around 60%. And if you look at the maths, the capital, paid up capital, which will be created post the demerger is likely to be around 208 crores. And this capital, in my view, is comparable with their peers because I have some data with me. And if you look at the Indian hotels paid up capital, it's around 142 crore. Mahindra Holidays, it's around 200 crore. Chalet Hotels, it's around 205 crores. Oberoi Hotels, it's around 125 crore. So I believe the company has decided to issue 1 equity shares for every 10 equity shares of ITC to come up with the right capital sizing, I would believe, and whether one gets, any number of shares in a simple demerger, actually there is no difference because the shareholders hold directly or indirectly 100% of the economic interest. So I think coming up with the right paid up capital post the restructuring was a sensible move by ITC. So that's it. I think that's why I believe the company would have decided on this particular share entitlement ratio.
Sure, we get that. But how is it that you would value ITC hotel business? Is there a valuation number that you have in mind?
I think the valuation will happen once the listing happens, which is expected after, I would believe, 15 months. That's the management estimate. So I think the pricing discovery would happen at that point of time, I would believe. But what happens is whenever you are demerging a business in a wholly owned subsidiary, the fair valuation is irrelevant. Even SEBI does not require you to do a fair valuation, because finally the same set of shareholders are holding directly or indirectly exactly the same proportion of holding in the business which is being spinned off.
So can Indian hotels be used as a benchmark to value ITC? Because Indian hotels, the profitability numbers, the size and the scale is slightly different.
See, if you look at the current turnover of the ITC hotels, it's around 2,500 crore. So obviously, I would believe ITC hotels would come in the top 3 hotels. And I'm pretty sure the market would look at some of these benchmarks, to finally price the share price rightly. But we are obviously 15 months away. And the important point is, what ITC has done is quite interesting. I would say it's unlocking the whole value in the hotel chain. At the same time, the ITC is keeping around 40% intact and continuing to, play its role as an anchor investor, because I believe the two companies will have a lot of synergies, going forward per se. So I see this as quite positive for the shareholders.
Final question. Will there be a treasury, will there be some treasury shares which will get created because of this? And if yes, could there be a possibility that ITC eventually could be looking at a strategic investor?
See, if you look at the announcement of the company, it's very clear that ITC Hotels will chart its own path, while it will continue to get the goodwill, the brand equity of the parent ITC company. And clearly, ITC Hotels will attract its own set of investors, strategic collaborators, etc. So obviously, I believe all the options are open in future.
Appreciate your time and thank you for joining us. Meanwhile, let me mark the markets and let's look at where markets currently are in terms of what the implied change for the Nifty could be. The implied change is that while we were not trading yesterday, markets were trading, or SGX GIFT Nifty was trading, and today's change, which means the GIFT Nifty is indicating that we could be about in and around 19,400. And if you add yesterday's minor dip, that could be a cut of about 85 to 90 points when Nifty will open, which frankly is nothing. But yes, from the recent high, you're down by about good 700 points on the Nifty, about 600 points on the Nifty, and 5% on the Bank Nifty. Chakri, why are banks selling off? I mean, they are the go-to sector. Everybody likes them. Everybody owns them. Numbers are strong, but suddenly banks are getting whacked.
Yes, good question. So as we went into this quarter, it was kind of expected that the net interest margins will actually be slightly low. And that actually happened. In some cases, like for example, City Union Bank 2 days ago, the slippages were actually a bit higher than expected. So as a result of that, the stock got punished really a lot, even though it wasn't an expensive stock. And this has been, and a few days ago, when Bank of India reported good numbers, their provisionings were strong. The net interest margins, while trended down, still was in line with expectations. So I think these are the two examples of what's happened to banks in a sense, is wherever you saw some banks slippages coming down, slippages increasing, they were punished more. Net interest margins are down across board. The stocks have run up, but the valuations are still okay. But because of all the downgrades that's happening in the US, so there will be some amount of pause on what will be the cost of capital for Indian banks if the RBI is forced to raise rates as a result of what's happening in the US.
All right. Meantime, some of the other stocks as well that we will be keeping on our radar include the likes of an Infosys. We discussed it earlier today, and JP Morgan as well, talking about that large deal adding about 70 to 90 basis points to the FY25 growth. Just wanted to get in your thoughts then, Chakri, on the kind of deal win momentum that we're seeing and what this spells out as a strategy for the IT sector as a whole.
Now, Infosys deal will momentum, last two deals, the one latest and one a couple of weeks ago, clearly, reduces some concerns about Infosys in particular because, their numbers were hurt most when they reported the earnings releases. Second, now with the continuous bank downgrades in the US, banks being, 25 to 30% of an IT services company's revenue basket, there is going to be some amount of pause as a result in discretionary spending of IT services. As a result of that, there is unlikely to be any positive surprises in terms of the order book. So IT services as a sector is, unlikely to be re-rated anytime until the dust settles on the US banks front.
Naresh, is there still scope for railway stocks to rally? Because now the move is getting slightly divided.
So in railway stocks, what we are seeing is a rotation. We saw it started off with RVNL, then we saw Ircon also catch up, Rights also catch up. In the broader space, it started with Titagar wagons. Then we saw even Jupiter wagons do well. And then finally, Texmaco Rail, which has been a perpetual underperformer, also went up 50 to 100%. And now we are seeing small names also in the railway pack doing well. So out here, it's a rotation. The trend is still strong. But the fact is some of the names have already moved up quite a bit. We even saw a spike in IRCTC, which does not have the as big an impact like the other names. But for now, one has to be very, very selective going forward. So the only stock which still fits the bill in terms of risk reward is Rights Limited because it's rallied the least. The stock used to be 430, 400 last year, and the stock is still at 460, 470. Whereas the rest of the names have gone up 100% or more. The stock is only up 15, 20% on the max side. So out here, right still looks very interesting. The rest of the names could take a pause.
Meantime, I wanted to understand, Chakri, from you as to whether or not you actually see the tide turning for a PVR Inox. No doubt it was a pretty stellar weekend and there have been impressive releases as well. Does this change the stance on the stock that has otherwise been through the grind, to put it mildly?
In the recent past, in the last couple of months, there have been some very big blockbuster movies, both English and as well as domestic names, which have done well. And that, PVR today is the de facto chain because there's only large chain left in the country today, and they have a disproportionate market share. And so they'll directly benefit. So in the short term, in this quarter, because of the current blockbuster releases, which have happened. Now, this next as we're going into the most important Diwali, post-Diwali season, when you'll have again a bunch of big releases. So, and valuations are still okay. You can see that their F&B has actually come down, which is not so good news on the margins. So I think therefore the stock will trade on slightly lower multiples.
Okay. Meantime, just wanted to also get in your thoughts, Chakri, as to how you've read into Nykaa's financials and whether or not you believe that, a bit of the pain is now behind us or is only going to continue for Nykaa.
See, in the case of Nykaa, their gross revenue, that number grew. But on the other hand, their fashion revenue was quite weak. The fashion revenue weakness is clearly because of competition. And so it shows that they're having a tough time in pricing their products. There is no pricing power in other words. So against this backdrop, so which means the cash flow generation or their net debt change in the company that was expected is unlikely to improve anytime in the next quarter or two. Given that, I think Nykaa is still we'll have to wait and see until the time the margins show an uptick.
Look at some construction companies, BL Kashyap, Capacita, Ahluwalia Construction. Some of these stocks have done exceedingly well. BL Kashyap, Forget the 1 month change, but in this year up 50%. Look at Ahluwalia, look at Capacitor. We don't talk about some of these stocks, but they've really done rather well for themselves. Ahluwalia contract 50%. I mean, this is like the good old business where you said that, look, it's a low margin business, highly cyclical business, very large in terms of debt, no clarity in terms of the management, and a lot of companies have really compromised the governance standards. NCC, another one. I mean, NCC's got a lot of road and government projects, but 84% this year. ITDC cementation, that has also done rather well. So there are a lot of stocks which in a sense are going to be important. Block deals, lots of them, Religer Enterprises, JSW Energy, and I think Indigo also should have gone by now in the FI window largely because it's a stock which is driven by institutional investors. Kunal, BL Kashyap, Ahluwalia, NCC, is there scope left for these stocks to go higher?
Yeah, I think for many of them, for NCC is the stock which I do track out of the 3 names which you mentioned, and I've been extremely bullish on the stock from the point when I think the stock was at 75, 77. That was a strong breakout point for NCC. 100 plus mark, I think 110 was the multi-year high for NCC. The stock was unable to cross those levels convincingly over the last many years. There were many attempts prior, but then this was a breakout point for NCC on the long-term charts. And I think from there, the behavior for the stock has changed. So, NCC, IRB, Infra, these are very high beta stocks. And when high beta stocks get into a change of behavior, change of trend, where post a breakout, they drop down their beta and they move into a trending move, with lack of correction or a major correction and more of time-wise consolidation, that is always understood to be a very good sign for these stocks because change of trend, change of behavior results into a long-lasting trend for these stocks. So, would be particularly bullish on NCC even from current levels. And I think we've seen 2 or 3 times where the stock has dipped some 7%, 8%, 10 odd rupees, 12 rupees in a short span of time. That's a classical zone to buy or accumulate the stock further.
M&M, that's the other stock which is in focus. And over the weekend at this mega event of theirs in South Africa, they've unveiled a new brand identity for their EV segment, and they've launched 7 lightweight tractors as well. Chakri, after PVs, they're clearly beefing up the farm equipment division, right, and that segment. And clearly 7 new launches now in tractors itself. Just wanted to understand, how much more do you think the stock can move from this 1500 plus level which it's already at?
The good thing about M&M in terms of being a sum of parts story is depending on the day the story changes. And here in this case, the good news is, being one of the largest, they're probably the 2nd or 3rd largest tractor company in the world. And, they sell to many countries, many important markets, including to the US. And selling into the US, the tractor is a very difficult task, given it's a very different farm requirements than from other countries like India. The fact that they've done well and the traction there is improving, and this being one of their main businesses originally, places M&M well. So the news flow momentum and therefore the order momentum for the tractor business is going to be strong, and therefore I think M&M still looks good, despite I was thinking that the sum of the parts has played off kind of a thing, but I think M&M does well even based on the current news flow.
Right, Chakri, great to have you on the show. Thanks as always for taking the time out. Since we're talking about M&M, let's chat a little bit more about the company. They've launched the EV version of Thar. However, the company is yet to begin production and no timeline of its launch has been given just yet. It also showcased a new pickup truck based on its Scorpio platform for many global markets besides India. Take a look at what Rajesh Jejurikar had to say.
We have done some more work on our brand architecture, and we felt our electric SUV portfolio needed a unifying brand identity. So we've spoken about Twin Peaks, and we're now kind of saying let's assign that to the ICE vehicles. But customers who are going to buy our electric SUVs should have a clearer proposition, and we hence have created an identity which we call the infinite possibilities. But as we started working with Mr. A.R. Rahman, who's working with us on our whole brand identity, creation and the music sounds for electric, which is a very important part of the electric experience, he came up with this line or phrase, if I may, called Le Chalang. And we hadn't thought of that. We were working on this thing called infinite possibilities. But in a way, we realized that Le Chalang is such a relatable way to say the same thing, because what we're doing is really telling customers that make this leap into the world of sustainability, the world of circularity, experience a very different product, and so on. So, that's the way we're thinking about it. And hence, over time, we really want to electrify all our products. So we're going to have this new brand or product brand called BE. Then there's going to be XUV.E, which is XUV.E8, E9. Then Thar.E, Thar.E. And then over a period of time, we'll do a Bolero.E and a Scorpio.E. So in a way, our whole portfolio will have an ICE element and an electric element. So that's really the vision we have for how to build this portfolio.
And Thar Electric, what kind of units you're looking at? Where will it be manufactured? Who will be the component supplier, the battery and all? Tell us something about the overall picture when it comes to Thar Electric, because it's taking the whole electric drive for you a notch higher.
Yeah, so these are early stages, Sumit, of the process, but the Thar Electric will come on the InGlow platform. So everything that we have on the InGlow platform, which we've spoken about, it'll carry over the same technologies of battery, motor, so on and so forth. So in a way, the backbone of the product is going to be similar to the other Born Electric. So it will have to leverage this existing manufacturing capabilities of Born Electric, which is being set up at Chakan near Pune in Maharashtra.
Okay, and talking about the overall, the play in the electric vehicle segment, right now from here to your overall targets, what kind of revenue, what kind of profits, what kind of overall contribution to your revenue and profits it will be coming like this? And you showcased one more electric vehicle here. Tell us something about the big picture here as far as electric play is concerned.
Yeah, so as you know, Sumit, we've spun off the electric SUV business into a different company, which is being called Mahindra Electric Automotive Limited. That company has now 2 investors on board. One is the...
All right, that's the latest with respect to the new launch from M&M stable. All right, let's find out what the mid-cap strategies are as we're checking in on those pre-open rates, quiet at around the 19,390 mark, and for the Sensex, we're down about 0.2%. All right, Kunal, what is it that you're picking out within the broader universe?
So I'll go with the Contraband Asian Paints. The stock is extremely oversold. We've seen the stock already correcting more than 15% in the last 1 month. And it's in most of the indicators, the RSI, MACD, ADX, etc. These indicators have come back into a deep oversold territory for Asian Paints. So I'm expecting a bounce from here, not a change of trend, but a bounce from here, at least another 100 points on the upside for Asian Paints. Buy with a target of 3,280, stop us at 3,160.
Right. Naresh, what's on your list?
So that would be a buy on Phenolics Industries. The stock, after giving the range breakout on 160 to 200, has consolidated, made a flag formation, and on Monday gave a breakout out of that flag. So a fresh 52-week high here. Good momentum for the stock. Looking at this as a target price of 250, stop loss at 200.
Right. Okay, let's move on and let's get you some buzz on D Street. And PNC Infra will be in focus today as the channel checks are now suggesting that the delay of asset sale still actually continues, and that overhang is maintained on the stock because of this delay. What else are the channel checks suggesting? Let me take it across to Vinny and find out all the cover. Vinny?
So absolutely, what we're seeing is now that, and this is according to channel checks, that weight that we'd seen coming in for the sale of assets of PNC Infra, that seems to have continued, and everyone had been waiting for the sale of assets for a longer period of time. Now seems like there's a further more delay coming in here, and the delay is being seen, which is remaining an overhang on the stock. 12 assets which the management plan to monetize have actually received offer of interest from investors, but that is still a delay, and what the management is saying that they expect the process to be over in the next 2 quarters. So let's keep an eye out on this one, because we've already seen a bit of a delay coming in for the sale of these assets, and seems like there's a bit more delay. They expect it to get over by the next 2 quarters, so keeping an eye out on that date finally, as well as Q1 numbers also were in line. Now when in the last 1 month also, you can look at the stock move. We've seen a decline of 4% coming in the stock price as well in the last 1 month, while on a year-on-year basis, the whole year when you look at it, yes, we've seen an increase coming coming in of 29%. But last 1 month, clear pressure has been seen coming in on the stock as well. So this is the channel check that we have suggesting a delay in the sale of assets for PNC Infra.
Okay, and let's now take it across and revisit all the stocks on Nikunj's radar.
Look, this is not the first and this will not be the last of the promoter stake sale. But what it does is that the overhang of, let's say, 25% stake sale versus the current post today's deal, the residual which would be left, I think that is getting reduced. The fact that Indigo has been in performing stock, I guess it just makes you wonder that where the stock is headed right now. So my view on the aviation sector, I think, is that whatever blip we saw in terms of air traffic number, that's not going to be substantial. B, my sense is that Indigo and Tata are the two large forces to reckon with when it comes to the entire aviation sector. C, I genuinely feel that there would be a price discipline in the aviation sector. I mean, unlike the Jio moment, I don't think Tata's entry into Tata's takeover acquisition is going to be a disruptive move, right? Yeah. So I think once the block deal goes through, this is not the first, but this will not be last. But the overhang, I think, progressively is getting reduced. The stock has been an outperformer. The news from the China, I think, is a clear indication that commodity prices will not go up in a hurry. I will not be surprised that the outperformance in the stock actually continues.
Okay, but at the same time, you've also got analysts, Nikunj, who are expecting losses perhaps in the coming quarter.
Yeah,
we
so
did
the coming
talk about the short-term moves.
so the coming quarter may not be all that great because the company has come out in the open and said that, look, we do expect a drop in realization and we do expect that there would be a drop in terms of where the traffic is moving. But you have to just go beyond. You have to look at Indigo and ask yourself that, look, this company, I think, has got all the ingredients of managing a tough time. Yeah. It managed COVID very well. It managed the 2021 time when the crude prices went to $130. They are, airline is a tough business. Yeah. Look at the history of aviation sector, both locally and globally. The companies which have filed for bankruptcy, I think, is huge versus the companies which have really survived. And Indigo is one company which has survived the storm. There's a technical overhang of stake sale, but my point here is that with each passing quarter, that overhang, I think, is getting reduced.
All right, let's also find out what the index calls are from our chartists. What are they advising this Wednesday morning? When it comes to position on the Nifty, it looks like it's tilting towards no trade. It's a hold, though, from Kush. That's the advice coming in on the frontline index. Remember, around 19,360 is what the pre-open rate is indicating this morning. More critical then to understand what the view is on the Nifty Bank Index, which has declined something like 5% from the top. You've got no trade, which also seems to be the call on the Nifty Bank Index, and Kush saying it's a hold recommendation.